Welcome to Kitco News. I'm Niels Christensen. Gold prices are holding critical support at the top of their range. Here to talk about the latest price action in the marketplace is Jasper Lawler, Head of Research at London Capital Group. Jasper, thank you very much for joining us today. It's always a pleasure to talk with you.
My pleasure to join you, Niels, as always.
So let's get started. Gold prices, big week last week, pushed above $1,800, their highest level since 2011. But as expected, we've seen some selling pressure. What do you think gets us sustainably above $1,800 an ounce?
Do you know what, Niels? I think that getting beyond, so we've seen 1800 in futures, and obviously we're looking for it to happen in spot. I think that actually we don't probably need a major catalyst, a continuation of this status quo. And I think that we actually just meander in that direction because there's no big catalyst to sell gold. You still need it for all these underlying reasons as a hedge, looking towards inflation, political uncertainty. There's all those reasons stand there, but you don't have the necessarily big upside catalyst either. And I think just the trend just carries us up. When I'm thinking that I get a little bit more worried about the price because historically we're looking back at those previous occasions when we were at all-time highs back in 2012, and there's some overhead resistance at this 1800 level. I think we break it, but then before 1850, I'm worried that we see a bigger pullback in gold.
Do you need to see a consolidation though? I like what you're saying, sort of meandering higher. And I'm sort of wondering, a consolidation at this point doesn't seem unhealthy to me. What are your thoughts?
I think obviously the nature of all markets, you pick up buyers when you have a correction, and I think probably gold needs that at this point. We can keep meandering, but that can't go on forever. And it seems to me more likely that we have some sort of setback. I would guess that the most likely cause of that is some sort of recovery in the dollar. It's attempted it a few times. I've been watching DXY, looking for some sort of sign of a bottom, but it can't quite make it. So for now, I think while the dollar's weak, gold meanders high. But if we do get a sudden burst of activity in the dollar, I think gold just by default pulls back, and it's nothing has fundamentally changed, but it does create that opportunity. It does create that pullback. And that then could be the opportunity to push much more substantially beyond the 1800 rather than just the meandering.
Okay, so you're looking at US dollar. What about equities? I mean, we have seen sort of this record move in equities, NASDAQ hitting all-time highs over and over again. Is this a headwind for gold? I mean, or is this just... I know last time we talked, we talked about, sort of this artificial environment driving equity markets. How does gold compete against that?
Well, fortunately, I think it's the same artificial environment that drives gold prices higher as well. It's money printing ultimately. That's the big thing that we're looking at, and I think investors are doing the right. I mean, it is artificial, but you're making the right investing decision in my mind to look at protecting yourself from this inflation. And you're not going to do it with very low yielding assets, but you can do it with assets that have growth, like equities, and hard assets that don't lose their value so easily, like gold. So both of them make sense to me. And in terms of equities, obviously tech, the FANG stocks, MAGA, the $1 trillion club, those are all getting a lot of the headlines. But I've been very much watching the gold miners, and gold miners outstripping tech. Some of these big names up close to 40% this year. I mean, it's a stellar performance. And so I think that goes to show you that actually there's just some underlying strength in gold production and as well as the asset itself.
So do you, if you're building a portfolio, do you have gold and miners? I mean, what's your thoughts on sort of this, the hard asset versus the miners? Should you have more equities or more raw commodities?
Well, in theory, they are correlated assets. So in theory, you don't want them both clustered into your portfolio, taking up disproportionate risk. But I would say at the moment, you do want both because equity markets are strong and gold mining has its own specific fundamental reasons, almost apart from the gold price. Of course, a strong gold price is good for gold miners, but also we have things like a very weak oil price. And so that just makes the cost of production so much lower. And so there are fundamental things that make gold miners good. Dividends that the gold miners are able to offer right now relative to other sectors that are having to cut and reduce and altogether wipe away dividends. There's lots of specific reasons why miners are good, and so why they're probably slightly less correlated to the oil price, to the gold price than they normally are. Gold, for the reasons we've been talking about, I think you always need it as that portfolio hedge. I think it should always form a percentage, but I think in these artificial markets, it should be a much higher percentage than normal.
So interesting then, and this is a question I've asked a lot of fund managers. Everybody says sort of the rule is, hold 5 to 10% of gold. You're saying, you should hold a higher percentage. Where do you fall in? Do you fall above 10%, or do you think 10% is a good allocation? Especially if you don't have anything.
Yes, I think if you don't have anything now, then you should make your way towards that 10%. I think it is a good benchmark for where you should be. I think 5% is too low. For me, personally, I push closer to 15%. I think beyond that, then for any asset, the whole portfolio becomes less diversified. Unless it's a pure trade on gold, then of course you're all in. But for a portfolio that's meant to be diversified, to me, I edge towards 15%. In this environment, not always, but I think gold has a lot further to go. Notwithstanding that maybe the correction here and there, as we said, maybe approaching 1850.
So we've talked about equities, U.S. dollar. Just really quickly, wanted to talk about yields. We have seen them fall since the June highs, but I'm sort of wondering, if we do start to see sentiment pick up. Do we worry about bond yields? And I also ask that in this environment of, a speculation that the Fed is going to introduce yield curve control, maybe as early as September. Are you paying attention to bond yields?
Well, I'm worried less about bond yields in the context of looking at bonds as a haven, and then that's if you're thinking that gold is also a haven. Of course, traditionally it is, but I don't think gold's status as a haven is what's the main driver of its upside at the moment. So if we're talking about the idea that higher yields perhaps make holding bonds a more attractive haven than gold, I don't think that's such an issue, because I don't really think that's why people are holding gold at the moment. And so I don't think gold holdings suddenly get displaced by bonds. I think it's a whole different set of objectives and reasons for holding gold in the same place, in the first place in your portfolio. So to that extent, no. And I think as far as yield curve control, that just feeds into the bigger theme of the Fed, in my opinion, overstepping their mark, intervening too heavily in markets, and basically becoming a controller of price in what are supposed to be free markets. And then again, it's not to say that gold is not. Similar things that have been alleged to happen in the gold market. It's not free of intervention from big institutions, but I think at least it offers you some safety away from fiat currency.
Okay. Last question then. So you see gold prices meandering higher. I like that analogy. What makes you sweat? I mean, obviously we've seen gold prices. A lot of investors coming in buying the dip. Where would you get concerned at the this uptrend? 1750, all the way down to 1680, sort of the previous sort of channel. What levels of support are you watching?
I think probably the round numbers are the biggest focus. 1700, but I think just below that, 1670. I know that's a little bit set back from where we are at the moment, but my confidence in gold won't be rocked by a few tens of dollars movements. I think we have to get a much more substantial pullback to undo the idea that we had a multi-year base and that we've broken out of it and that we're in an uptrend. I think the pullback would have to be very large to ruin that overall idea of what's happening in gold. But still, looking at that, I think people would get unnerved if we move through 1700, and then below that, I look at 1670.
But do you see those like in this uptrend? I mean, do you see that as like just buying opportunities? I mean, is that sort of this continuation of buy the dip that we've seen, since prices back down from 1800, really?
More or less. But I mean, to your point about what would get me worried, it's almost two factors in one. It's the dollar, and then it's using gold as a source of liquidity when people need dollars. So that sudden appreciation in the dollar, that remains to me the biggest risk factor for gold. But I think what the Fed have done, not only is it just a broad idea of money printing, but they put in policies that make it unnecessary for people to have to sell other assets in the open market, sell other currencies in the open market to get dollars through these swap lines. They're being underused at the moment. Some central banks have barely used them at all. But that optionality of that being there just means that people don't necessarily have to sell things out like they did in March. And so that's a risk for me there. But I think it's less of a risk than it was in March because of these new Fed policies.
Jasper, thank you very much for your thoughts. I really appreciate the advice about how much gold an investor should hold in a portfolio. Thank you very much for talking with us today.
Thank you very much to you.
For the latest in the precious metals markets, go to kitco.com. Stay safe, stay healthy.